Welcome back to another weekly market and financial update. I hope everyone enjoyed the long weekend and enjoyed their Labor Days with their loved ones and family members. So we're back. We were off last week. I was away. I know, I'm sorry, but we're back. And this week's timing, I think, is excellent because the market has been a little volatile at the tail end of last week and a little volatile yesterday. And the market's open down this morning and they're up now this afternoon. And I think there's going to be more volatility throughout the rest of the week. So let's break this down a little bit. So, why has the market been volatile over the last few days, and why is there anticipated volatility for the remainder of the week? Well, historically, September, I think, is a month that most market cycles would like to forget. I think most markets don't like their September month. September's historically are down months compared to other months throughout the year. But the recent facts that have been happening are something we've actually been talking about. So if you've been watching these videos over the last few weeks or even the last few months, you know that I've been talking specifically that the economy has been cooling down. And the manufacturing data that just came out prove that fact. Manufacturing data came out and showed that it is continuing to contract and slow down in that sector. The non-manufacturing data is supposed to come out tomorrow, and that also will be a determining factor of whether or not the economy is continuing to slow down and contract. My personal belief is that it will, in fact, prove that the economy is continuing to slow. In addition, we have the jobs report coming out on Friday, and that is a really, really big one because the jobs report that came out last month was weaker than expected and thus prevented the markets from really accelerating like they have been throughout the remainder of the year. So I'm not so sure about the job markets on Friday. I think they might come in right around as expected, maybe a little bit softer than expected. I don't think they will beat analyst expectations, knowing that manufacturing companies are contracting, therefore reducing their payroll. Non-manufacturing companies are probably contracting and therefore also reducing their payroll. And a really big and somewhat surprising factor, I think, this year has been technology, specifically AI companies. AI companies now are starting to slow down a little bit from their absolutely tremendous run up throughout this bull market from the beginning of the year 2024. And with AI also getting to slow down, again, a lot of these companies are still small and immature compared to well-established firms, and smaller companies tend to be the first ones to let go of payroll, especially when they're slowing down and revenue drops. So that's what I'm expecting, and what that means for you and other investors out there is that, yes, there will be some volatility within your portfolios, and you may not want to log into your account this week. I'm only kidding, of course. Log in as much as you'd like, but just know that there will be some expected volatility. And another contributing factor here as well that is not often talked about from public sources or from the media because I think it's relatively misunderstood, but just know that if you own a mutual fund or ETF or some other form of pooled investment vehicle, there's a portfolio manager behind that underlying investment, and portfolio managers are making decisions throughout the year to make trades. And when portfolios or different funds reach certain high points or watermarks, portfolio managers will rebalance or place sells to lock in some gains. Whether or not the fund is overall is actually performing, there might be some individual performers within each fund that they say, hey, we're going to cherry pick and we're going to sell. But not to get too technical, all that means is that these mutual funds have trillions of dollars. And when a very large mutual fund makes a big decision, it can also have an impact on the markets because the impact is so significant because there's so much money involved. There's a very large weighting to that fund. And we've seen portfolio managers make shifts in their portfolios. They are trying to lock in some gains. They are expecting volatility just as much as we are here at Vision Retirement. So that is another big factor contributing to it. It's not necessarily an indicator that the economy is doing poorly or that we're heading toward a recession. It's just them being strategic and being smart about the decisions they're making to help protect their investors with their growth objectives or downside risk capture objectives. So again, these factors are really not mentioned so much in the media, but they do have a big impact to markets as a whole. So just know that volatility is here. Again, if you've been watching my videos. You know this was coming for a few months now. We've been talking about it. All eyes over the next few weeks are going to be turning. Well, first we'll be turning towards the job market report on Friday. Then we'll look toward the Fed decision on interest rates later in the month. And then, of course, we have the big one coming up, which is the election. So we'll talk a little bit more about the election. We've touched on it briefly. We'll talk more about it as it approaches and what sort of impact it can have on the markets. There have been some media highlights recently about geopolitical concerns with China, Russian, and Iran. I know, what a shocker, right? We have some issues with geopolitical countries in those three. But those issues aside, I think some of the domestic issues, or I won't say issues, but some of the domestic data points that have been coming out, I think those are really the focal points. So when making decisions with your portfolio, just always make a decision that is strategic and not one that is emotional. It's very easy for us to log into our account and be like, oh my gosh, my account is down 3% today or 4% today because of some data point that came out, whether it's the job markets, a particular industry that's been cooling off, maybe the CPI numbers a little bit hotter than expected, whatever it might be, right? Just know that these things do happen. Market corrections are very, very normal. The Fed's goal has always been to slow down the economy and curb inflation as much as they can. So I don't foresee any major underlying issues, just some minor ones that were really expected and already priced in by markets. So if anyone has any questions on this, again, please reach out to us. We're here as a resource to each and every one of you. I always love doing these videos during periods of market volatility because I think there's a lot much more to talk about and a lot more strategy to be involved when it comes to making decisions around each of our investment portfolios. So again, any questions that come up, please reach out to us. We're here for you guys. And I look forward to speaking to everyone next week when we have data on the jobs report. That's going to be a good one. So make sure you stay tuned for that. So with that in mind, have a great rest of your day, everyone, and I'll see you next week.